You're listening to the ROI channel. Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today I'm super excited to welcome a popular guest. Everyone has been asking me about this particular guest and saying, when are you going to get him on the show? And I said, I will do my best to get him on. And he has been gracious enough to accept the invitation. Today I'm talking to Fergus Cullen, aka Trader Ferg, very well known in the FinTwit and YouTube community. Ferg, welcome to the show. Thank you for coming on and joining us.
Thanks for having me on, Ben. It's good to be here.
My pleasure. Mate, I thought we might do a little bit of introduction into you, your background, and how you got involved into investing and speculating. For viewers, Ferg is also the author of Ferg's Find. It is a free newsletter that has just amazing nuggets of gold in it. So I'll leave the link in the description, and I highly encourage you to subscribe. Again, it's free. And he is also heavily involved in Crux Investor publication. Again, the links will be in the description. And disclaimer, anything that we say today, guys, is just purely our opinion. We're not financial advisors. None of this is advice. And you're responsible for getting the appropriate advice before making any decisions. And so you, Ferg, maybe if you just walk us through briefly your background and what led to you being such a popular trader that people follow and getting involved in the investment community.
Yeah, well, I never really expected any of this to happen as such. I'm off a farm in New Zealand. For anyone that doesn't know, I went to universities to study agriculture and just decided quickly farming was a difficult way to, you got a crap return on investment. So quickly decided to change my degree and went into property. That led me down sort of property management and development, and ended up going to Australia and ended up in asset management. Through that, I met my mentor, Brad McFadden, who's been pretty key just to pretty much everything I've done since. He's been my mentor for about 10 years now. And so he was sort of a proprietary trader through all his youth and for various sort of banks around the world, trading their capital. And now he sort of runs a fund in Australia and also works with Chris Capitalist Exploits and has his own service as well. And so meeting him when I was working in Australia was pretty key. And so as soon as when I was in New Zealand, I always dreamed of sort of having the corner office in the suit and going up the skyscraper, and thought that was sort of the key to happiness. As soon as I got there, I was miserable. And so started to sort of plan my exit strategy, and that was via sort of learning the markets. Decided it's funny when I think about it, because started off with farming, which is a lot of hard work for a really poor return. Property was better, but then when I found the markets, I was like, this is me. This is where I can kind of express my view on the world and live and die by sort of being right or wrong. And so, set the aim of quitting my corporate job by the time I was 30, quit on my 30th birthday, and set off, left Australia, and had some sort of just a few high net worth clients that I managed money for, and moved to Europe and lived there, just managing their money on my own for nearly 2 years. Lived in Berlin, where my sister was, so we hadn't seen her for quite a while, so it was good to catch up with her. And then decided I didn't like living in Berlin, and I didn't particularly like managing people's money, especially when the way it worked was you kind of have, they make you like an authorized what do you call it? You have authority to go in and put trades in the account, but they've got the overall control of the account. And the way I trade, they like my returns, but they didn't like the trades I was putting on. And so often I'd go in and buy something that was just teetering on bankruptcy, and they'd go in and close a position out, say, no, you can do anything but that. And I'd be like, but that's my angle. That's
why you pay me to manage the money.
Yeah. And so finished that up and came back to Australia to see my parents who had who moved over to Australia to retire. And then afterwards, my sister said, how about a holiday in Bali? I said, okay. I hadn't heard great things about Bali from sort of Kuta and Australians, the miners flying in, but we went further up the coast to now where I now live, which is just above Chengdu, sort of rice paddies and a little place called Puranan. And yeah, never left. Met my my girlfriend, now fiance here, and have been here coming up 5 years now, and just trade my own accounts. I didn't have any social presence up until COVID. So my whole sort of social media presence was because of lockdowns and being bored, and so started to tweet and just played around online, and that's what blew up. And yeah, before I knew it, I was getting asked to have interviews, chat with people, and then Crux kind of spilled over from that. I just really liked what they were doing, and I just said, yeah, how about sort of coming on the platform and doing it more regularly? And I said, sounds like a kind of a dream setup. I get to do what I love to do all day, and I just have to summarize it in a video form and get to interview smart people. Like, what's not to love about that? And so, yeah, that brings me to today, pretty much.
Absolutely. And although you've probably condensed maybe a decade's worth of hard work in great investment and speculation into about 5 minutes is a great summary. I think Ferg is a typical humble Kiwi, guys, very understated. The guy is underrated, which is kind of like a breath of fresh air when you look at the financial sphere. And there are quite a few people that are very overrated. You are certainly not that, Ferg. The work that you do with Crux, you publish a video like bi-weekly or once a week, something like that. Is that correct?
Yes, I try and line up an interview with a fund manager, a trader, just someone I find interesting. Really not management of companies, because I find that skews my view of the companies. So generally, I always want people's skin in the game. That's kind of my one like rule that I find. Like, what I've found is the interviews that I'm seriously curious are the ones I'm happy with. If I ever do one which I'm not curious about the person, I just don't find it's a good interview. So yeah, pretty much that once a week. And then another one is just what I'm doing, what I'm interested in really. Is it a trade that I'm putting on? Is it something I'm selling? Is it something that I'm seeing in the markets? Just like I don't know, like I had a big deep dive on why I thought like windfall taxes and how to like try and dodge that. Sort of 6 months ago, had dives into all the various sectors, whether it's like coal, tin. Like I just, once I've almost got, what do you call it? Once I get obsessed with something, I can't leave it alone until I've kind of put the jigsaw puzzle together in my head. I've got
so you get that tunnel vision, and you just want to
real tunnel vision. Yeah, all my sort of friends and family members kind of know me for it. Yeah, kind of slightly obsessive until I understand something, I won't leave it alone. Yeah.
Okay, I have to say that the quality of the videos are absolutely top notch, guys. So do feel free to check it out. So what gave you that courage to leave the corporate scene? Was it just the fact that you knew that you had to change, or you got to a position where you were reasonably comfortable and said, you know what, I'm now in a position where I value freedom and enjoyment more than I do like continuing to stack paper on paper on paper? What gave you the audacity to leave what I suppose most people would think is a dream job, to say, look, it's not really what I'm after. I'm after this freedom, this ability to go to Bali and be on a beach and find that, I guess, life of total freedom.
Yeah, so it was a few things. It was obviously the money side's important, but it wasn't. A lot of people think they have a far higher figure. I left my job on the riskier side, like I'm talking like low 6 figures. So it definitely wasn't like the sort of 7 figures, what do they call them? The FIRE movement, the sort of live off 4%. Like I joked I was more in the sort of having to make sort of 20-30% a year to survive, if not before growing accounts. So yeah, I definitely wasn't on that side. I was more on the aggressive side. And I knew if I didn't do it then, I wasn't going to do it. But before long, I probably would have had a mortgage or met someone that tied me down. I was at the point in my asset management job that my next jump up, a lot of your earnings are paid in like vested shares. So yeah, it vests on a 3-year basis. You kind of you earn great money, but you get locked in, and then you've got this ever larger amount of vested shares. And then Aussie's just a prick as well with the tiers of tax. Like
Tell me about it.
Once you're above 180, like why are you even working between super and then the government taking 50%? Like you're getting 40 cents on the dollar. I was just like,
I can vouch for that.
Yeah, this is ridiculous. So I decided it was now or never, and decided to go for it. Yeah, so probably a bit early, but made it work, and it's worked out just fine. So yeah, I don't know if I'd recommend people follow what I did. Yeah, I get a lot of emails like sort of people wanting to exit corporate jobs and how to go about it. And my saving grace was I kind of found the real edge in the markets, particularly in income trading, and that worked a treat. And I really did that sort of day in, day out for sort of 2-3 years. And I really had a solid edge there, that not only could I sort of cover my income, cover my sort of expenses, but also grow my account, which is not easy to do. Yeah.
Mm-hmm. And we're definitely going to touch on that today, guys. But I guess that's interesting when you look at, if you're aiming for a 4 or 5% withdrawal in retirement, you need a massive capital stack in order to make that work. But you invested in your abilities to spot investments or speculations that could give you a much higher IRR or much higher return. And therefore, of course, you didn't need such a large capital stack in order to fund your lifestyle. And as I guess you touched on that geo arbitrage of if you move somewhere less expensive than Australia, which is basically everywhere in the world, you could have that arbitrage in terms of the currency and the cost of living and all that sort of thing, which is really interesting. But why Bali in particular? You've got Australians there ruining life for everyone. I mean, never underestimate the Aussies' ability to ruin the nightlife. But you could have gone basically anywhere in the world. What was it about Bali in particular that caught your attention?
Yeah, so me and I done a lap of the world sort of in 2019, sort of wondering if Bali was for us long term. So we kind of wrote out a list where else might we want to live, and we just bounced around. We spent sort of a month or so in Portugal. Spent 2 months on the sort of Adriatic coast between like coastal like Croatia and Montenegro, where she's from. So Mia's Montenegro. And also went up around some parts of Eastern Europe. So into Georgia and up around there, and just saw what we thought. My sister was in Costa Rica, so it was interesting what she thought of that. And overall, we just nothing compared with Bali. Bali's an interesting place in that you've got this like nice tropical island, chilled vibe. And yet you've got amazing kind of infrastructure in the way that a lot of Aussies have come over and brought like the cafe culture. You've got great restaurants, you've got good food. Both of us like have our hobbies that are here. Like we were talking before, I do Brazilian jiu-jitsu every morning for an hour or two. I love like the sort of all the grappling there, and it's like a really high-end gym. Mia's got horse riding here. So it's kind of, it's a weird mix of it's
great diversity.
You can get full diversity. We can be surfing, love the beach, walk the dog. On the beach at least once a day. And then within an hour behind us, we can go up into the mountains where there's lots of like this weekend we went glamping, been right into that lately. There's all these spots opening up and just amazing locations that have these like kind of like high-end tents. They've got aircon, they've got doors and stuff, but you just kind of get away from the beach vibe and go up into the mountains. And I haven't found anywhere close to it. And I can also go and see my family and friends in Australia, and like my parents are now retired on the Gold Coast. I can get to them. We used to be able to a direct flight. Hopefully it's coming back soon. And I've also got quite a few good mates that do sort of FIFO mining, and so they are constantly over. So we sort of hang out for 2 weeks and they go back to work and then come back over. So yeah, that's kind of a lot of the reasons.
Yeah, strategic location. So you've touched on a typical day in the life of Ferg. What do you imagine yourself doing in 10 years' time? Like, what's a typical day going to be like in 10 years' time? Still going to be alternating between the beach and the mountains? Still going to be rolling jits? When you look out now, what would you say is in the imagination for a day in the life of Ferg in 10 years' time?
Probably the same, just with kids, honestly. Yeah, I don't really, I'm not very materialistic. I don't really want much extra. Yeah, I don't know. We've just got a new place near the beach, so we can walk to the beach. So that was always a dream. Yeah, I don't really want a lot more. Honestly, the place I've put most money lately has been both Mia and I have been our parents. Like it was Mia's been completely renovating her parents' house that they retired to, and I helped buy my parents their sort of dream place on the coast in Australia, and that's really been our big sort of dreams to help sort out our parents. And other than that, we're pretty happy. We live a great life. Yeah,
that's fantastic. In terms of moving towards more of a macro perspective and some current commentary around macro, what do you expect from a macro environment perspective moving forwards, and how are you positioning your portfolio to, protect the family's capital and potentially grow it? As you know, inflation's a hot topic right now. You were talking a lot about the energy dynamics years ago before that became sort of mainstream. As you look out now, what do you see is happening or going to happen in the macro environment, and how are you positioning to protect and take advantage of that?
Yeah, so it's an interesting one, because I think we're at such an interesting point at which a lot of what people have leaned on over the last few years is going to stop working. It's an interesting time when you've got a lot of like quants and a lot of people using data back to like as far back as computers go. That's what they're drawing off, and yet I think you're probably going to need to have gone back further to get sort of a good view of what's going to happen. It's not much use sort of your window of observations just when there's been falling rates, and so you draw these conclusions over one particular period. So
very cherry-picked segment, perhaps.
Yeah, so you've got to kind of study history a bit more, and probably the first observation is just everyone sort of talks about inflation as if it's something that the central bankers and everyone wants to get rid of, forgetting that I think it's Louis Gard stated it's not a bug, it's the feature. It's how you get on top of very high debt levels. Like you could lift rates quickly and sort of squash inflation in the 70s when you were at sort of 30% debt to GDP, but once you're up in the sort of 130,
different story today.
Yeah, you just got to inflate it away, and so that's the game. And if anyone's listened to the likes of Luke Groman, said you kind of work out that they're pretty much going to be forced to print money to sort of patch over the lack of tax revenue. They're going to have to print even into sort of where inflation's still in the teens, and so the game is just it's gonna be high inflation. Sure, it'll spike up, pull back, spike up, pull back. Same as energy, same as like you're seeing with, I think of an example, gas and LNG in Europe. It's the game isn't looking at like the relative highs and lows. It's just the absolute level, and the absolute level is going to keep grinding higher. And so once you understand that, then you've got to start saying, well, real assets over financial assets, and then where do you want to be in the real asset space? And that's where energy gets the most interesting, because not only do you have the supply demand dynamics, and I'm always a big proponent of focusing on supply, but you say sort of where is supply being actively like damaged? So you can go to an investment conference and they'll all put up like a great presentation of the supply demand dynamics of gold. Someone will do it on copper and someone else can do it on oil. But the difference is with oil, it's been actively like hindered that sort of supply response. And so that's why I'm being so bullish on the fossil fuel complex, and why I've got such a strong view. And at the same time, you've got a whole lot of other factors, like this whole sort of the whole sort of net zero push, destroying sort of energy density on the other side. That's just going to give this a massive runway. I think the biggest mistake people are making is everyone keeps asking like, oh, thanks so much for sort of getting me onto like Whitehaven. Do I exit now? Like, no. Like, if you don't exit, suddenly get 1 to 2 times cash flow. Where are you going? What's comparable? And so I think that's going to be really hard, as people just hanging on to real assets, and they're going to be surprised where this all goes. I think I was talking recently with someone. One of the things that really stuck with me, can't remember which book it was. Might have been Neil Ferguson's When Money Dies, but he's pointing out that a lot of the really experienced speculators in Weimar, Germany, they got crazy prices for some of their assets, and they're like, okay, yeah, sell it. And then they were happy for a few weeks, few months, and then just inflation just kept rocketing, and realized, yeah, keeping the asset was even in against ridiculous prices. I don't expect that sort of inflation, but it is a good sort of analogy for thinking. Probably be careful of getting out of cash flowing commodity assets too early.
Yeah, when the wheelbarrow is valued more than the Reichsmark that they hold, then it's something
Exactly.
wrong.
Yeah, exactly.
Well, you beat me to it. I was going to ask you about Whitehaven. I had a chat with Emmanuel Datt last week, who mentioned that stock as his highest conviction. So this is this interesting situation where, because of the balance of payment issues for particularly the US, that they set the tone for the rest of the world, whether we like it or not. The Fed can only raise rates to a certain point, and the economy then slows. And as you say, well, then they're missing tax receipts to be able to pay or service that interest. How do you see like Cuppy's Project Zimbabwe thesis, for instance, playing out, where he says they can, they'll raise rates, and then we may enter a situation where they're raising rates and stimulating via money printing. We go back to QE in order to kind of, like, we're juggling all these different plates, that it's obviously not going to work. But how do you see us? Are we getting closer to Cuppy's thesis not being so facetious and actually starting to play out? Like, that's a little bit scary when you think about it.
Yeah, well, we can talk about like Cuppy's, or I was reading the book at the moment when we were up in the mountains. I was reading it's Marco Papernak's Geopolitical Alpha, and he's got this idea of the Buenos Aires consensus, and it's kind of similar in a way to what Cuppy's talking about with Project Zimbabwe. And this, whenever you reach a certain stage of populism, people will just vote for more money, and you kind of overlay that with what Cuppy and also Luke Groman's talking about, that yeah, they're just going to have to print the difference to make the budget work, and all these different factors combining, yeah, it's not good. And that's why you've got all these different factors that are suggesting inflation's here to stay. You've also got the big one. The one that always annoys me is people attributing sort of a lot of the deflationary pressure to technology. Whereas I think there was two big factors that often get overlooked. There was obviously globalization, and there was China, which was sort of their rule of thumb was if they achieved 9% GDP growth, then they would create 20 million jobs. And that's what they needed for sort of social stability in China. Well, that's now flipped, and it's going to be, I think within another year or two, they'll be down at sort of negative like 8 to 10 million jobs. So they don't need that sort of excess sort of GDP growth anymore. So that engine of globalization is being shut off. And also just the misunderstanding of just how kind of rare the sort of last 2 decades of energy abundance we've had. So China 7x'd its coal production from 2010 to 2011 and just gave us abundant, cheap energy. And then as soon as they decided to wind it back on the back of sort of pollution and just environmental damage, then the shale boom took off. And then we got extremely cheap energy again. And now both of those have rolled over. We're sort of pretending we can replace those two sort of energy booms with renewables, and finding out, like, I was looking at a study the other day that Germany has added 93% additional capacity over the last sort of 20 years, and yet they've only added 1.8% additional generation or production. So it's all this sort of renewable capacity, and yet it's not translating to actual production. And so those two massive trends are just going to be super inflationary moving forward. We've no longer got the sort of unlimited cheap labor that China was willing to provide, and we've gone through all the cheap energy in the world. And so if you use that as your model for how you view the world, and then you realize it kind of is going to turn into a bit of a balance sheet war, because all these Western countries are over their skis with their sort of debt levels, then if you have that framework, I reckon you'll do really well. And that framework just leads you down positioning in various forms of energy. And yeah, I think that's where the massive outperformance will be. And that's how you play the whole sort of global macro, if you will.
Okay, so with these trends of lowering cost of capital and cheap energy, that has, population and demographic changes, that's allowed us to have these cheap consumer goods and technology, and create the solar panels that we're trying to say is giving us an EROI that'll allow humanity to survive. But once we take that into account, and we say those trends, like the cheap capital and the cheap energy, is days gone. Energy is inelastic in that we need it in order to be able to survive as a species. How do you work out which forms of energy you're going to look at in terms of an investment trend? Like, which trends do you see are overrated, and which trends do you see as underrated, particularly in regards to the energy trade?
Yeah, so overrated, that's easy. Just anything wind, solar, biofuels. Biofuels is just atrocious. I think if anyone's read, Bloomberg got this great piece on the biofuels, like subsidies in Europe, just burning, essentially cutting down forests in the US and to bring over wood to burn it in.
Isn't it? It's like back in the caveman days.
Yeah, dirtier than coal. You're really seeing the green ideology showing through. I was reading an article before about how Germany's pushing ahead with shutting down the remaining 3 nuclear plants, and one of them is going to be directly replaced by a oil burning plant. Yeah, like, just talk about an ideology. But yeah, back to your question. It's I could talk about renewables all day. I'd love going through the I think the easiest way to explain them is they do not provide an energy return on investment to the level that we need to maintain current society. So you need, for the sort of for the level of society that we've become sort of accustomed, you need to be somewhere around at least the 10-to-1. Most renewables, if not higher, when you get up to, for sort of healthcare and for sort of general abundance, you need to be sort of at least at a 12-to-1 energy return on investment, and renewables are barely giving you sort of 2 to 3. And so there's a whole lot of issues. And I've been trying to think of like the right analogy. I did have an analogy. I think I might have borrowed it from either Charles Hall or Michael Kelly, the guys that were the original sort of Charles Hall was the guy that came up with energy return on investment. There's this sort of idea of using a cheetah as the idea of what is the economy, and then what it eats is in terms of energy return on investment. If you're chasing around, say, like wildebeest, like that's a high energy return on investment. The cheetah can survive, the cheetah can get fat, bring up its family, and the whole sort of pride of cheetahs, or whatever it's called. Coalition, that's right. Yeah, I did know that.
It's a great name.
Coalition of cheetahs can thrive, and yet where we're at now is got quite a fat cheetah off the back of, as I mentioned before, China 7x in its coal, the shale boom, and yet now we've decided that we're no longer going to hunt wildebeest. We're going to start chasing around rabbits, and that's sort of a direct analogy for wind and solar. And so it's easy to picture the idea of a cheetah kind of chasing rabbits around all day. It's a lot of energy to hunt them down, and you're not actually even covering the energy that you've invested in hunting. So you can no longer bring up offspring, and the cheetah slowly going to burn for its fat stores and start starving. And it's this general idea of energy starvation. And it just amazes me the fact that we're seeing such clear examples of it with Germany around the world, and yet the likes of Australia are just pushing ahead with it. And when you read the reports that it's based on, the thing that I take the most issue with is generally the learning curve. And it's just this idea that you can forecast out sort of cost reductions, sort of just extrapolate them. And so there was a recent study, that one that Australia is basing its sort of renewable build out on. And for most battery, solar, wind, it was just assuming sort of around 10 to 15% cost reductions year on year compounded, and pushing that right out to 2040, 2050. And the biggest joke is just this year alone, it's actually been the opposite. In most areas, it's sort of been a cost increase of sort of 10. And then you've got the fact that the maths just doesn't work, because take solar, the module cost has been what's been going down in price. So that used to make up sort of 30% of total cost of installation for solar.
Which was a result of cheap fossil fuel energy, right? Like the input to create those.
Yeah, that as well. Like if you go to where the majority are made in China with forced labor, slave labor, possibly, and made with coal. But then you've got the fact that that module has now gone from 30% of the cost to 10% of the cost, which suggests the remainder of the cost is now the materials, polysilicon, which is up 300-400%, depending what info you're using, and labor. And so I don't think those are going to follow the learning curve down. So you've got this sort of reduction of it's a big difference of 10% per year on 30% or 10% on 10%. And yeah, I think that is like the most overrated trend, and that's going to cause the world so much harm until we kind of start pointing out the stupidity of it.
Yeah, well, as I said, mate, don't underestimate the ability for Aussies to mess things up. But yeah, I mean, you can't be very intellectually honest if you're looking out at these extrapolations and these models for 30 or 40 years. I mean, just even a small error in your models is going to compound year on year over 3 to 4 decades. It's very easy to go wrong. Like, it's just such a fragile basis or framework for your thinking. In terms of, I guess, on the flip side, what is the most underrated theme out there in terms of the macro environment? I know you have spoken a lot about offshore in terms of and oil services. The idea being, I guess, that CapEx for commodities in general, but definitely in the energy sector, has been way below replenishment levels, and we're starting to see a squeeze in the energy markets. Is your thinking that the CapEx has to rise in order to rectify this supply demand situation, and that CapEx, one man's CapEx is another man's income, and you're kind of looking further out into the derivatives or the ripple effects and saying that these offshore companies are the most underrated? Or
yes, you can already see this. All you have to do is Google where's Saudi aiming to get its additional production from, and they're just buying rigs hand over fist. If you dig into Josh Young's work, their sort of claims of being able to produce 13 million barrels a day is just fantasy. They're using their inventories to sort of patch the difference. And so they're like, a really simple question to ask is, if they've got such cheap sort of conventional assets, why are they having to go out offshore, which is sort of in the $40 range? And why are they of their the capacity they're trying to bring online, I think 4 of the 5 are offshore. And so,
are you suggesting they may be reaching the limits of their spare capacity, Fergus?
Yes, I am. Yeah, No, Josh has proved this quite like just every time they go above that, that I think they're the highest they've produced on a year is about 10.5 million, and they have managed on a 3-month rolling. I think it was 11.5, and they only ever got to 13 for maybe it was a month. And yeah, Josh has just shown that they're drawing down their inventories like crazy when they're doing that. And yeah, there's some pretty funny arbitrages. I don't know how much you want me to go down this rabbit hole. I love it because there's you've got how they even like IPO'd in the first place. Like Aramco tried to do the rounds with all the Western brokers and said, like, we want a 2 trillion market cap. Everyone just said, "Oh, show us your books." And anything they showed, they said, "No, you're 1 trillion. This is bullshit." And so they sort of gave up on the idea that they were going to get it in any of the Western markets. And so what they decided to do, they took it home and they floated it on the sort of the Saudi domestic market, and forced all the princes and everyone to prop up the float. And then they did secondaries based off the domestic market there to maintain that valuation. So that's how they kind of got away with that valuation, which kind of leads into that whole conspiracy of their reserves are a lot dodgier, a lot lower than they're stating. And yeah, I forgot where we were going. Oh, we're going with offshore just in general. So offshore is I just love a sector when you just watch the whole sector go through bankruptcy, write off. I think across the entire sector, they've written off like 20 billion. And most of that was assets that you get on the balance sheet today. So I always love sort of examples. There's some really clear-cut ones, like one that's almost perfect, I think, is Peabody, where they went out and did I'm forgetting the name of the asset they acquired in Australia, but they spent roughly 5 billion, and then they went bankrupt and wrote off 5 billion. So that asset's still there and still going to pump out cash in the future, but just the previous shareholders subsidized you, and that's what's happening across the whole offshore space. And before they even went bankrupt, they a lot of these went through Chapter 11. They had a rough 4 years, so they had to try and survive, cutting costs, cutting all the fat out of the business. So these are pretty lean operations now. And what surprises people is when you show how they're actually quite a way below sort of shale break-evens now. And so that kind of crushes the whole theory that shale is going to be come sort of roaring back to life and going to be the savior of the sort of the energy deficit. So yeah, and to add to my bullishness on the sector is part of the problem with having clear views on the likes of coal and oil is just getting hammered by government intervention, sort of windfall taxes. And so I've kind of coined the idea of sort of trying to go with a more sort of picks and shovels approach, that you sort of get the service companies that will have the margin expansion and will hopefully dodge these sort of cash grabs by governments. Hopefully, never know. Though I got wrong-footed recently I had a bull call spread on a bank, and I said, "Oh, the government, the EU won't go after banks," and yeah, they did. They're windfall taxing the bank, so got to be a bit more.
The EU can nationalize or smash anything, mate.
Yeah, anything that shows a profit, it's like whack-a-mole. Yeah, just they need a fund.
Well, you're beating me to it. I definitely want to delve into that. Before we wrap up the macro, I've got to ask you, if I were to put you under the gun today and say uranium, coal, or tin is another one that I've heard you speak about, where would you say the most upside is in those particular sectors?
Oh, that's tough. Yeah, that's tough. I like coal because it's hard to screw it up when you're at sort of 1 to 2 times cash flow. I often joke coal's kind of the long that you can get on policy maker stupidity. And so every time they say sort of this is aims with a net zero policy, you just know it's going to be coal. There's like those IEA charts where the world's running on 90% wind and solar. All that means they're not going to invest in any real infrastructure like a nuclear build out. And so, they'll fall back on the easiest quick fix, and that'll be coal. And so coal's great, but then you're not going to get the sort of, or maybe you do, but I don't see it getting the crazy sort of multiple expansion, the boom. So that's where I love uranium. I love the interplay between uranium and coal as well. They almost hedge each other. Uranium is what we should be doing, and coal's what works when we don't do what we shouldn't do. So you'll win on one side or the other. And so I've still got a massive uranium position. Most of that was not because I sized it massively. It was because I built a lot of it in March 2020, and it's just become a large proportion of my portfolio. And yeah, I'm not trimming it. I'm just trying to build the other, build sort of coal, oil, and tin, and particularly tankers at the moment. I love the product tankers, and the mid-range dirty tankers are where I've been pouring all my sort of excess capital at the moment. But yeah, coming back to between tin, uranium, and coal, they're different setups. Like coal is like a slow grind. Like I love this idea of like, talk about sort of if or when sort of trades, but you can also talk about if or when risk. And with coal, it's kind of, it's not a sort of if you get your money back, it's when you get your money back. When you're buying something, it's sort of 1.5 times cash flow. You'll take Whitehaven with sort of picking up 10% of their stock buybacks, dividends. It's going to be hard to screw up their trade. It's hard to have a value track when you're getting that much cash flow. Yeah, you earn your way out. But whereas uranium, I think the upside's far greater, because it's going to, just a small market, you're going to have the utilities at some point enter the market, and their price is sensitive, and they're just going to squeeze the hell out of it. So I have maintained, it's probably some of my more like cool like positions are like, I think like Alligator, which is Bannerman. Those ones that are just, I don't really think, Alligator certainly doesn't. That's more of a play on sort of the pounds in the ground being re-rated, but just can see that being squeezed to high heaven. And which I think we will, sort of the Sprott corners the market at some point, and there is that maximum squeeze there, and then we'll probably be rolling a lot of that across into coal. Coal's a trend that I think will play out for far longer. I think uranium will get squeezed to high heaven at some point. And as for tin, I love tin. I love the supply story, but been smacked around the head with it purely because of the demand side. So whether you like it or not, and this applies to a lot of trades, is they are highly dependent on China. So whether we like it or not, China's gone from sort of just broad commodity sense, a lot of the sort of capex type commodities, they went from sort of consuming 5% of them in the sort of 70s and 80s to like 50% of sort of global commodities now. So when they shut down with these sort of COVID policies, you can't help but sort of get hurt. And tin, especially, with the majority of electronics being made in China. So it's the question I get the most often is like, should be really leaning into the positions that have been hurt at the moment, because they're China's obviously crushed them. Dry bulk's another example, dry bulk tin. And I'd say yes, if you got patience, I would be loading the boat there, because I think ultimately you'll be fine, but you might just have to wait a few years. Who knows? I'm not going to pretend I know when China's going to open up, but could well follow. I think it's always ironic when everyone say, oh no, they won't stay closed that long. Or how many of us were seeing that in the West with COVID? 3 months, flatten the curve. Yeah. So who's to say they don't stay closed another 2 years?
Don't say that, mate. Don't say that. I'm sweating on the reopening trade in many ways.
Yeah, well, I am as well. God, I've got dry bulk exposure. I've got a lot of tin. So yeah.
It's interesting because, I mean, potentially things could work out really well. I mean, uranium can get squeezed. You're sitting on some gains that you can then roll into coal, which, considering we're not expecting margin expansions or multiple re-ratings, probably better to say, that then you can sit and put that into more of a higher free cash flow to EV yield. And maybe if EVs or electronic plays really take off, obviously the tin demand is going to is going to increase, and there are really only two ways that you can play that at the moment. So that, who knows, that could work out perfectly. In terms of your investment process, I would love to really delve into that, because you have a signature move. I'd like to read a quote to you and then talk about what I call the Ferg move. And the quote is that there's a lot of money to be made when a company goes from being utterly fucked to just hopeless. Can you tell us the origins of that quote and what it means and how it applies to your investing?
Pretty sure that's Cuppy. I've heard that that quote stated in multiple ways. Yeah, I think my mentor's even got a version of that. It was one of his first observations when you'd go to the short sellers conferences, and they would always leave the the bottom crawling stocks and be like, oh, you're not going to milk that last sort of 20% of your short. And they're like, no, that's the danger zone. That's when you get completely run over.
Interesting.
I was like, the danger zone, that's where I like to be, where they're sort of crawling along the bottom, and it's, as you say, just everyone thinks it's absolutely dead, never going to come back, and it just has that green shoot and pops its head up, and that's when you really load up. And especially if you've got a sector where you get a huge margin of safety, which is what's happened with offshore, where they've wiped out all the debt. Like, what is the argument against them over a long enough time frame when you've got this huge amount of steel and labor and energy that got put into all these rigs, and then you get all the debt wiped out, and you just get to partake in the upside in the future. You just got to have obviously view on.
That's one of the biggest things that I've learned from you, is this idea of like subsidized asymmetry. For someone who might not have heard of that before, just a brief explanation. What does that mean? And then how do you take advantage of that? Like a relisting after chapter 11, perhaps, and then the use of maybe some bull call spreads to really give the trade some extra juice.
Yeah, so it's how I've made a lot of my money is by going after these sort of post bankruptcies where I just think there's value, and I usually wait for there to be a bit of a smash up or something that I just think you're kind of aiming for peak bearishness almost. So two examples come to mind. One was Paladin. You had it having gone through bankruptcy. They had the whole Lager Heinrich mine, and it just I guess they still had to pay down their debt, but if you believe uranium was going where it was, then it was just a no-brainer at that time, and was helped by any questions, sort of any worries I had. There's quite a smart community. That's where Twitter is amazing. It's like Centurion 888, who I like to call a friend, and like I would just hit him with it's like, how about this? And he'll be like, this is the breakdown of why this is not going to be an issue. And that's when I took him Peabody originally, and I was like, yeah, I think this makes sense when they're talking about their second bankruptcy. And he's just a lot smarter than me, and he was like, back the truck up. Like, this shouldn't be like a 1 or 2%. This is like a bigger trade. And it was that same idea there. So Peabody had gone through bankruptcy, had bought some silly assets, got over the skis, gone bankrupt, wiped out, I want to say 7 billion. I can't remember what the actual, maybe it was 5. But yeah, wiped it all out, and you could just see the runway of just profitability. Like once you've removed all that debt, you've still got all the inherent assets. You've leaned out they're not doing anything silly because they've had such a hard time. They've had to lean out their operation. And you also, the trick is being close enough to the inflection of things taking off. Like with Paladin and with Peabody, it was just lucky to be close enough to the point at which the underlying coal and uranium prices were going to start inflecting, and then you just get monster leverage, and that's when you get your sort of your 10 baggers and things like that.
So it's the previous shareholders have subsidized you because they've taken the bath in terms of the bankruptcy, and You're coming in with a clean balance sheet and expecting asymmetric upside.
Yeah. So it's having a very strong view on the sector, and then you're kind of looking for the most hated. Yeah, it's what my mentor always taught me, is like, find the most hated sector and then find the most hated company in the sector, and sort of say, is that is that reasonable? What would it take for things to go right? Which is going back to your when you were quoting Cuppies, that is just utterly fucked, just slightly fucked, or whatever it was.
A bit
It's
less.
just yeah. It's the idea. And if you're on the back end of a bankruptcy, you've got a massive margin of safety, because generally what's happened is most of these, you've got the like senior debt holders, they're going in and they're having debt for equity swaps. So they're trading in all their debt, and then they're becoming new equity holders. And so they've just taken a serious haircut on their debt. So they're looking to make good on the equity. So it's one of the few times when you're actually sort of, if you're buying as soon as it's relisted, you're kind of entering on good terms with the smart money, if you will. They're going to give themselves at least a few years runway for things to come right. And so that's where I love to be. And often you can get warrants to kind of give yourself a bit of extra leverage, or it's where I like to be.
Yeah, it makes a hell of a lot of sense if you know what you're looking for. In terms of your investment process, how much of that would you say is top down versus bottom up? Like, do you find that sector that's the most hated and then dig through, or are you, when you go to do your bottom up analysis, how much weight do you give to top down versus bottom up?
It's probably 50-50, if not more weighted towards top down. And when I say top down, I don't believe, like, I almost never make trades on sort of global macro. Like, I'm really suspicious of sort of talks of like guessing this GDP print, or guessing this sort of plain like inflation rates with this instrument, or it's just, I think a lot of that's just like economists speak and chief strategists and all. I just don't.
We know
like,
how
I think,
accurate economist forecasts are.
yeah, but where there is an edge is where you can have sort of the top-down macro within a sector. So like the obvious one is like uranium. Like, you can just go through, there's X number of reactors, X number of pounds roughly, and at some point that equation is going to have to balance. The price of uranium is going to have to go. So I'd call that like more like sort of niche sector, top down. And then once got a super strong view on the supply demand of the sector, which is what that's where I kind of always start. And then I start going through the sector, looking at charts, looking at what companies are sort of bombed out, crawling along the bottom, and then where the sort of bottom up comes from, start going through the balance sheet, working out where I can get a good margin of safety. And that often leads me to these post chapter 11s, or those sort of plays. Or, as you say, going with bull calls if I just want to be a bit more of a trader. That the bull calls are just a sort of a very useful tool when you see something that is just ridiculous. I always use the example of when that Ukrainian reactor was on fire and all the uranium stocks got absolutely smashed, and you're like, oh Jesus, this might be bad. And then some of the news flow started to say, well, actually it's just like a sort of a shed out the back of the site. It's nowhere near the reactor. And then thought, okay, well, everything gonna bounce heavy on the open. And when it didn't, just laid into the bull calls. And that's just kind of like arbitraging, sort of just people being silly and panicking. And sure enough, those all roared back when everyone worked out it was just a sort of a false alarm a day or two later. And the reason for the bull call working well is because it allows you to sort of wade into high levels of volatility. Normally, if you wade into high level of volatility just with a straight call, you're just paying through the nose, and it kind of kills your payoff. But the lovely thing about a bull call is selling at the higher leg helps sort of subsidize the cost, and you can kind of get your fixed payoff.
Nice. In terms of position sizing, how many positions would you hold typically? And then what would a typical position size be for you? Like, just in getting a picture of your asset allocation and how you manage some of these, I guess what some people might think of as higher risk trades.
Yes, position sizing is absolutely key. Like, it's probably the thing I like kind of fret over the most, and I've always tried to optimize it. It's always one of my favorite questions to ask of sort of other traders and fund managers is how to sort of optimize position size. so where I've kind of ended up is generally sort of the 3 to 4, and if I've got really decent conviction, push up to 5 is kind of my sweet spot overall. And I usually try and maintain, try not to let any individual or any sector, say like uranium or something, get more than that sort of quarter, like 25% of the portfolio. Obviously that gets well out of whack when things run, and it's hard to kind of manage it then. But yeah, that's been my kind of framework that I've fallen on, because when you break it down, like you're battling two separate ideas. One is how to not let yourself get hurt, because it's damn hard to make your money back. Like sort of a 90% loss, got to have a 900% gain to get back to it. Like just the maths makes it really hard to make your money back. And yet at the same time, you don't want to take that so seriously that you only ever have 1% positions, because then when you have your 10 bagger, you don't move the needle as much as you could have. It doesn't. So it's trying to counterbalance those two. And so, yeah, where I've found the sweet spot is at 3-4%. And then occasionally I break my rules. So I broke my rules when in March 2020, I just kind of the way I explain it is just when you can see it's just a sheer like kind of liquidity driven panic, and like you can tell that there's people aren't making rational decisions, like the whole market's just getting trashed, and that's like your time to back up. And so that's probably the most I've ever pushed a position size, which is like 10%. And so but yeah, wouldn't recommend that at all. I think that sweet spot of sort of 3, maximum 5 is where I'm at, and that's pretty consistent across the portfolio. If haven't got the same level of conviction, I can just start at 3, and then if it pulls back and I do more research and I like it, then I might buff it up a bit more. If it's more of a speculative position, then it's going to be less like a sort of like a alligator energy would always sort of be sort of 1-2%, just because of its nature. Yeah.
And over how many positions normally would you have open at any given time?
So per sector, it's usually, it depends on what, like you've got sectors like tin where you just got bugger all to choose from. And so you really got 2 to choose from. And then, it's cuts it down. But just by the mass of it, obviously you usually end up with sort of between 5, and if you've sized them down a bit, like maximum 10 per sector. But I think overall my portfolio at the moment, probably only like, I don't know, 20, maybe 30 positions. I haven't counted.
Okay. That's interesting. Well, it's ROI time, guys, and we're going to move to the segment where I asked Ferg about his specific experience related to the concept of ROI. And the first question, my friend, is what is your highest ROI from any investment to date?
I was thinking that. So I've never talked about this one before, but I've got this stock in the corner of my portfolio, which is, it's kind of embarrassing, and also it's been a big winner. It's Liontown, and I bought it for 3 cents. And I often, just when I want to research something and I thought that's an interesting story, I just chuck $1,000 on it, and then I aim to come back to it. For whatever reason, I never came back to it. And it peaked out at 65 bagger, and it's currently at a 55 bagger, I think. But it's kind of embarrassing because it goes against a lot of what I talk about is that you should keep track of these things and add to stuff that's really doing well. But this one completely got away on me, and every time I looked at it, I was like, oh, that's funny, that'll probably mean revert, and just keep going. So
wow. Liontown, what is it? I've never heard of that company in my life.
I haven't actually dug into it that much. It's I think it's a copper and nickel producer, I think, in Australia. They just obviously struck a big deposit and just went berserk. It's kind of embarrassing that I didn't ever even add in another $1,000 to it. Like, Jesus Christ. Like, it's it's a funny position because it's like a painful reminder that don't let asymmetry get away on you. Like I should have, every time I thought, oh, that's interesting. It's run up like that. It's obviously run too far. I won't add to it. I should have been adding to it. But then again, it comes back to my whole idea. I had no conviction on the position. I never even put the effort in. So it's what I always like refer to with even with the whole crypto thing. Like people often reach out to me, sort of what sort of trader are you if you can't even just risk a little bit in some of these because the asymmetry is so great. And I was like, oh, I'd prefer to push all the chips across the table with something that I have high conviction in, and I can really move the needle that way. Even if I had got convinced of Bitcoin, it would have been a small position and it wouldn't have moved the needle as much as something I have high conviction of. And yeah, really put some serious money into. Yeah, but yeah, no, that's my highest. It might, yeah. The looks of it, it's climbing at the moment. If it gets to 100 bagger, that'll be pretty ridiculous.
Well, you've given me an exclusive anyway. I'll have to come up with a clickbaity headline. Fergus Cullen throws a 65 bagger. That's so interesting. And I guess from here today, looking out over the next 12 to 18 months, what is your highest conviction stock or asset and why?
Yeah, so that one's tough. So I've got this whole concept of like the hurdle rate. And so this is because it's important to separate between conviction and payoff. So some things I go into, I just like the payoff, but I might not have as much conviction. So I've got the idea of a hurdle rate, which is what I kind of judge my whole portfolio by. If I'm entering this position, is it above the hurdle rate of what is my kind of my no-brainer, high conviction risk reward? And for a long time, it was just physical uranium. So it was whether it's yellow cake and now Sprott. And then when that climbed up to sort of the $50 odd pound, I say, well, that the sort of incentive price is getting within reach. So I'm going to switch it over to coal, and in particular Whitehaven. And so Whitehaven became my hurdle rate, and that was like a year and a half ago. And it still is that now. Like if something isn't a sort of a no-brainer purchase over Whitehaven, then why am I sort of purchasing it? I either want sort of an outsized return of a multi-bagger, sort of, or I'm just going to put more money into Whitehaven or other coal names. I'm kind of building out a whole coal ETF purely because I don't want to let Whitehaven get too large with the current example of what Queensland's done with smacking around the head with royalty taxes. I'd like to spread it out a bit more. But yeah, I've still got pretty large positions.
So that's interesting. Even in terms of the run up in nominal pricing, you think that the cash flows the company can produce means it's just as good a value? Or do you think, where do you think we are in that trade? Are we a third of the way through, half, 2/3?
Oh, with the stupidity going on across the world with sort of energy policy, I think it's got a long runway. Yeah, it's always the interesting one was the sheer amount of emails I got after Peabody. So I gave like an hour presentation on Peabody. It was about $3, got to $33 or something, and the amount of people were saying like Hanks, like we're out, we're gone. This is like, yeah, I'm selling out. This is just ridiculous. And the thing is, like, I wish people would just focus more on cash flow, just whatever metrics, free cash flow to EV or EBITDA to EV, even though it's not as good, it's easier to run, and just focus more on cash flow would help so many people. And I've noticed a lot of these, it's actually gone down. So a lot of these are just absolutely printing cash. And I think if you focus more on that, it'll stand you in a lot better stead for like what's coming. And that's just a full-blown energy crisis, essentially. Yeah, we're going to have some pretty negative consequences before people start asking the hard questions and switching policies. Because yeah, at the moment there's also a lot of sort of scapegoating of Russia. Like, yes, Russia certainly didn't help the situation, but it wasn't the actual underlying cause. And if anything, you can argue that in like the energy situation, the stupidity of Europe emboldened Russia to do what it did. Like, it could see that they were weak and it could prey on that. And so yeah, until that sort of starts to get more widely known, then yeah, I think a lot of these energy trades have got a long runway, and it'll be a mistake to get out. And there's also the simple question of, where do you go? Like, sell Whitehaven, tell me where you're going to put that money. Yeah.
Yeah, where can you find something that, 2 to 3 times cash flows with 20-year mine life and inelastic demand, or growing demand potentially moving forwards? Yeah, it's so interesting that maybe the biggest thing is being able to just wait and sit on those gains, as uncomfortable as it may be. So in terms of exit strategies and opportunity costs, to that point, what are in your mind the key signs that would make you think that we're close to a top, and that you'd start to think about taking some money off the table in terms of these trades?
Yeah. So this is the hardest question to answer, because it's definitely more of an art than a science. I wrote a long, well, not a long blog, but I wrote a blog on it probably 2 years ago now, called Monkey Trap. And it's just this idea of you kind of get slaughtered if you're greedy. And the monkey trap analogy is like, there's a trap they use in Africa, where you just get hollow out a hole in a coconut, tie the coconut to a tree, and then you just put a few nuts in it, and you know that the hole's just the size of the monkey's hand when it can fit it in the coconut. But once it grabs the nuts, it can't get the hand back out, and the monkey can escape as the hunter's walking towards it, but it refuses to drop the nuts, and so it gets killed. And so it's this idea of, if you're not prepared to leave any gains on the table, then you're kind of going to ride it down the other side. And so I wrote a blog about sort of how 50% of my exit strategies, and it's always scaling. So one of the things that just should have tattooed on anyone that wants to do trading is a sort of more of a full-time thing, is scaling is so key for so many aspects. Scaling into positions and scaling out of positions, doing it gradually over time. You should never make really binary decisions. And with exiting positions, it's especially key. So I wrote that article that was on uranium, and so had some certain fundamental sort of indicators when I looked to start just chipping away at my uranium position. So from memory, there was when spot exceeds term price by, I think it was more than $20 a pound, I'd probably chip off 5%. And then, yeah, had a whole lot more fundamental, like how many companies, when the amount of companies in the sector is just exploding. This every moose pasture is now a uranium producer. And then you switch over to where it becomes far more art and science, which is like the behavioral. And this is if you're in an Uber and the guy front's telling you his favorite uranium stock, you're at a barbecue and someone asks you what uranium you're invested in.
They start talking about Liontown.
Yeah, start talking about Liontown. Yeah, just everything. And so I've got a whole list of examples like that. And of course, it's all behavioral, so it's kind of hard to track, but you'll see it if it starts popping up on CNN, if Kramer starts screaming about how uranium's the best trade for the next decade, like just, and often you see extrapolation come in. So when you see like really, it's funny, I did a piece on when you've got greater full in like greater full cranking, you've got to actually move away from any fundamentals. You've got to start talking about the ultimate price of it, or how many X it's going to go up to attract people in. So kind of like the Bitcoin 1 million, like because there was no fundamentals, they just have to come out with outrageous prices, or have to, like what Cathie Wood does, like how she even got away with saying that ARK was going to do 40% a year for the next 5 years, like just provide arbitrary sort of amounts to get retail excited, because you're trying to drag in like the marginal retail buyer. And they're
essentially painting the tape and bidding up those prices, because it's not based on fundamentals. So why is X price any different to 10X to, I guess, people, you run out of retail investors to drag into the trade. I guess that's what you're trying.
Yeah.
So in that vein though, before we wrap up, so scaling in, scaling out is key. And, I totally get it. We don't want to overstay our welcome, because the backside of the hockey stick is just as steep as the front side. But if you look at the last sort of the last stages of the bull market, that is where a disproportionate amount of the gains often are when it comes to like the silver bull market of yesteryear, for instance. So is that how we manage keeping some chips on the table to take advantage of that, like overshoot to the upside, but obviously taking a little bit off the table so that we don't essentially blow all the stack and lose all the paper gains when it comes crashing down? Is that fair to say? Is that how you're looking at it?
Yeah. So Jim Rogers has got a great quote where he says he was involved in the silver market and he sold 1 month from the blow off top and he missed half the move. And so that always stuck with me. Well, one observation is just to always remember that crazy spike, there's bugger all liquidity. So it's actually hard to sell positions into that. Like it's if you're trying to move a decent position, you got to kind of be selling into liquidity on the way up before it just flies up and then crashes. But yeah, I think it's healthy for your psychology to probably try and ride the spike at the end with maybe 15-10% of your account, but you want to have banked the majority on that climb. And that's why I'm talking about sort of chipping away 5% on all these call signs. Oh, and back to the monkey trap, except you're going to miss the top. It's even if you do have a bit of the account, yeah, chances are you just ride it down the other side and you'll be happier that you hit the bid all the way up. It's just, yeah, there's so many analogies for it. Like it's like the thing everyone wants to watch the last minute of a football game and think they can get first to the car park. It's just it's not how life works. You've either got to sacrifice something, which is those potential games, and leave a little bit early, or you've got to accept that you're going to be in with everyone. I forget what it was talking about, like greater fool theory, which is the greater fool buy it off you, and there's also like slower fool theory, just expecting you'll be faster than other fools, and that's its own fool theory. But no, I think you can have a little bit of speculation that you leave on just to. I often recommend it because it's funny how your brain works when you've taken the majority of the position off, but you can still sort of cheerlead your last bit. It's almost like plays to human psychology, and you've got a little bit in the game, so you're still happy. Like it hurts everyone if you get off and you watch it 3x again after you've got out, which it invariably probably go somewhere crazy. But it shouldn't stop you from doing the right thing and chipping off, and also asking, like, just having set goals of like will that extra money make any difference really as well? Yeah, which is it's a hard question to answer, because as soon as your desires always go higher as your count's going higher as well. So
wise words. So don't be a monkey, guys. Leave some of those nuts in the trap so that you can get away with some gains. But thank you so much for joining me. I got a great deal out of this discussion, and I know the listeners will as well. Ferg's Finds free newsletter, link in the description, guys. Make sure that you subscribe to that. And if you're interested in getting Ferg's breakdowns, do consider the Crux Investor subscription. Again, there'll be details in the description. Mate, is there anything that I missed that I should have asked you that I didn't, or are there any thoughts that you'd like to leave us with before we wrap up?
Not really. I think that was, I covered everything. Yeah, I just the question that's always the hardest that I always get from people is like how do we change sort of silly positions. Like particularly one that hurts me is like some people in Germany that have kind of understood how silly decisions are, and then see governments keep making worse and worse decisions. And my sort of recommendation is always just the only thing you can do is kind of profit from it, and then you give yourself options to choose to go where you're treated best. And that's like, you're not gonna we're just simple citizens. We can't change any of these policies, so you can just vote with your feet, and that's ultimately getting yourself in a position where you have those choices and have that independence to make those decisions is probably the most important. And I always feel bad for people that I'm sort of ragging on the policies, but they're trapped in corporate jobs and mortgages, and they're getting dragged along for the ride, kicking and screaming. So that was one point that I always feel bad for or struggle with.
No, definitely. Look, we can only control what we can control. Mate, I'll have to get you back on in maybe a few months to see how all this is playing out. But in the meantime, guys, check out the details in the description. And I look forward to seeing you in another episode of the ROI channel. Thanks, everybody. Take care.
Thanks so much, Ben.